In this example, we are looking at the time value of money and the early extinguishment of debt. We have Infosphere Inc., and they have $350,000 of 4% bond issue that was issued a number of years ago at face value. There are now 10 years left on the bond issue, and the market interest rate is 8%. Interest is paid semi-annually. The company purchases the bonds on the open market at the calculated current market value and retires the bonds. So the first thing we're going to do is we're going to use the present value tables to calculate the current market value of the bonds. So this is similar to an example that you've done before. It's just kind of worded in a little bit different way. We have to find the present value of the interest payments as well as the present value of a single payment, the lump sum payment when they get paid back. Okay? So we have 20 periodic payments because there's 10 years left and it pays semi-annually. So we go to table 2 when we're calculating interest, and first we calculate our interest down here. We have $350,000 is the bond issue times the 4% times the 6/12 is $7,000. So when we go to table 2 and we use 12 periodic payments at 4%, because remember it's 8%, but it's paid twice a year, so we use the 4%. And we take that factor times the 7,000, we get 95,130. And then we have to take into account that not only are they going to earn interest payments, but they're also going to get the bond back at maturity. So the maturity amount is 350,000, and we have we go to table 1 now because it's a lump sum payment, and we have 20 periods again with 4%. So we find a factor of 0.456, and then we add that together. The issue price, or the total present value of the bond issue, is $254,730. Part 2 wants to know, is there a gain or a loss on the retirement of the bonds, and if so, how much is it? So down here we're going to take the face value of $350,000, the cash paid that we calculated here, and we end up with a gain of $95,270.